Market volatility has certainly picked up a little bit lately, and seasonality-wise, September is not a good month for the market. But I'm going to share with you 4 reasons today as to why we shouldn't freak out yet. My name is Brian Cannon, and welcome to Markets in 5. So the first chart here is the daily chart of the S&P 500, and you can see that the market is still having an uptrend, right? Meaning higher highs and higher lows. So that is not a bad sign. That's good. So there's no warning signs there. Now RSI we want to see stay above the 50 range, and it just poked its head right below the 49 range. So we're watching that closely. But as it stands right now, everything is trending the right direction. Everything's above the moving averages. So we've got a few warning signs here. We've got a little crossover here on the MACD, but aside from that, everything looks pretty good at this point. So no warnings here. Now, when we step back and look at a longer-term weekly view of the S&P 500, something that's very, very important over time, you can see, is that as long as the weekly number is above its 40-week moving average, then it's the market usually is not in a state of turmoil. So you can look back historically over and over and over that when the weekly number drops below the 40-week moving average, it coincides with the RSI dropping down below 50 as well. So those two work in tangent, and you can also see a lot of times we get a crossover to the downside on the MACD. So between those 3 indicators, that's a good sign to kind of watch for. And so where we are right now is we do have a negative divergence, meaning that price action has been heading up while momentum on the RSI is dropping, as well as on the MACD a little bit. So could be an early warning sign, but we are watching that very closely. But as it stands right now, we're above the 40-week moving average on a weekly basis, and RSI is positive and MACD is positive. All right, another chart that we look for when we're trying to determine market direction and rollovers is we want to look at the 5-day moving average of the S&P 500 in relation to its 100-day moving average. And when the 5-day moving average is above the 100-day moving average, usually the market doesn't mean that we're not going to have some volatility and some pullbacks, but what it does mean is that it's nothing to be concerned about or get freaked out about. So right now the 5-day moving average is well above the 100-day moving average. The trend is still again positive, but again, is this it's positive until it's not, and it's trending up until it's not. So we've got to watch these numbers and watch these lines and just make sure that that everything is trending the right direction. But as of right now, there's no concern, and so we stay put. We might make a few tactical moves, but nothing major or strategic at this point. All right, I've gone through this chart several times just because to me it's extremely important. There's a lot of movement out there with the Fed and discussion about the Fed bringing the rates down, and they should have already done it. They've made it clear that they may begin rate cuts in September, but they're going to keep a tight monetary policy until April, is kind of what they're saying right now. So the risk is that they don't take that they keep the monetary policy tight for too long, and if that's the case, it really could impact the markets and really could swing everything down. So we want to watch this closely. But every time that we've had a yield curve inversion, it's always preceded a recession. So here we are with an incredibly inverted yield curve right now, but it is heading to a normalized yield curve, meaning that rates are beginning to drop, and again, that usually precedes a market pull down and a recession. So we've got to watch this number very, very closely. So again, it's not anything to be freaked out about now. And it is a longer term kind of indicator. So it's nothing you can make a quick judgment on or make a strategic movement based off of. But it is something that you need to have in the back of your mind and really watch closely, because when this yield curve normalizes, a lot of times the market does roll over. So we've got to watch that one closely. But as of right now, nothing to be freaked out about yet. So as you can see by these indicators, there's not a lot to worry about yet. Markets go up, they go down. It's volatile for sure. But until some of these indicators get broken to the downside, no reason to freak out. But we are keeping our eye on it. But let us know if you have any questions, and I look forward to seeing you on the next Markets in 5.